Welcome, everyone. I'm Rochelle Wilhite, the designated broker of Best Choice Realty. Happy Monday, happy spring, all of that today. Happy to be with you today. We're going to be covering a topic tonight. Have you vetted your lender? I've got that on the screen. I've got Deanne Yellum and Sam Sentioli with me today, as well as Shannon Hall, who will be helping me go through this short presentation. Before I do that, I know a lot of you want to know what's going on in the mortgage world. So we have Sam doing our mortgage minute tonight. So I'll turn it over to him and then we'll go ahead and get started.
Okay, thanks. Just real briefly, rates. We're still down from the peak earlier this month, when we were playing with 7. So November of last year and beginning of March this year, we were right around 7. We're down from that, and with a lot of volatility. Rates are in the mid 6s in general. So, just to keep things interesting, on top of the rolling pandemic and the supply chain issues and the war and we've got a banking crisis now. This is people are predicting it's going to make it harder for the Fed to raise rates if they need to, because it will make the banks' investments lose even more, which will make more likely there could be a run on the banks and more bank failures. So this is potentially a bad thing for interest rates if they can't aggressively get a hold of it. So we'll see. I mean, like I said, all those things I just mentioned are all almost unprecedented by themselves, but you add them all together and nobody really knows. Wednesday of this week is the Fed meeting, and they're gonna have a press conference after that. So that will be a big deal. There's probably gonna be a lot of volatility depending on what they say. So no predictions for up or down, other than there's probably going to be some volatility. And mid 6s doesn't sound too bad after we've touched with 7. So we're for the month we're trending down anyways.
And there's a lot of activity. I think I've heard, Sam, from at least the brokers from this weekend. Last weekend, less people because of the whole bank thing. But then this weekend, I think a lot of people are like, "Ooh, let's go in and get something done," right?
It does seem like there's more activity, yeah.
Okay. Thank you for that. Appreciate your insight on that, Sam. Let's go ahead and get started. So we're going to talk tonight about, have you vetted your lender? We actually have done this session before, but it's been a few years and we needed to update the slides, and also some contract changes have happened, and certainly it's a different environment than a couple years ago. So I think what you'll see tonight is a little bit of role play. I plan on doing that with Deanne. So I'm going to use her as the lender of, really, have you taken the time to vet your lender, whether it be Dan or any other lender? Many of you need to probably kind of revisit that, because what I'm hearing out in the field right now, in fact, I just got off the phone with a Compass agent. She's actually going to be writing an offer on one of our listings. She's like, I put in the remarks, this program or that program because of the type of condo it is. And she's like, "Oh, I actually have used that guy." And I said to her, I knew I was doing the call tonight. I said, "Are you planning to use that lender?" And she's like, "No, the client came with their own lender." And I was just like, oh gosh. So now I'm vetting her to vet her lender that's going to write an offer on a condo specifically. And I'm thinking, she hasn't been trained, and many of you have not spent the time to make sure that you have a solid lender partner that can assist you, be a backup, second opinion. By the end of the call, she's like, "Who do I need to call?" You certainly know the lending world. And I go, I'm not even licensed as a loan officer, but you do need to know how to properly vet your lender to be a lender partner. So we're going to go over that on some tactics. We also want to cover a little bit about how to look at the pre-approval letters. I think that's key, as well as our learning. And then to wrap at the end of the half hour with a copy of the 22A, specifically the financing contingency. I think a lot of you are not understanding your forms. So I'm going to go over a little trick at the very end here for you. So let's go ahead and go to the next slide, Shannon. So this is a slide. It's funny because one of our new brokers, he jumped in. I think it was Jamie, actually. He actually listened to the recording. He joined after I did the webinar. with Sam a few years ago, and he actually had this thing printed, and he went and interviewed several lenders just to try to find one that was a good fit. So he actually had screen captures. If you're a new broker, take a picture of this slide because it's a really helpful slide. It's basically my interview guide when I was interviewing a lender to see if I wanted to work with them. So I'm just going to kind of go through what that would look like. So just a 5-10 minute role play. Deanna has been so kind over the last several months to kind of roll with me. So we're going to see how this goes. So the first thing I would do is set up a time. Many lenders want to meet with you. They certainly want to build their business. And certainly, you know that I've gone through this process already to vet Sam Sentioli and Deanne and their team over at Movement Mortgage. So anytime you're working with a Movement Mortgage lender or Michelle out in Spokane, all of those lenders have been through a vetting process, much like you see here on the screen. So Deanne's already been through, we did a dry run already many months ago, but let's go ahead and get started. So I would just sit down with this lender and just say, Deanne, tell me about your company.
So we're here in the Northwest, but we're actually a national company. We have over 4,000 loan officers that help people across the country. So Movement, we do things a little bit differently. We do upfront underwriting. That's the first thing we do. And underwriter, after they look at it, we have our instructions to get your loan closed quickly.
Okay. So
you may not know this, but we were actually acquired in 2018, and we were Eagle Mortgage, and a lot of people in the Puget Sounds work with Eagle, and we had one of the best reputations around, and that whole team went to Movement Mortgage.
Yeah, the husband and wife that owned Eagle Mortgage, their broker works for Best Choice. So it's kind of fun. The younger generation has joined Best Choice Realty several years ago, and he tells us a lot of good things about his parents and when they ran Eagle. It was a great company. And so to kind of pass the torch that way, it's kind of fun to see that process happen. How long have you been in the business specifically, Deanne?
Well, I started when I was 10, and I started in branch banking. So lots of years. And actually, I started at Washington Federal, and I went through being a branch manager. I did some underwriting, and most of the loans that we did at that time were called Make Sense loans. So that was Metropolitan, that was later acquired by Washington Federal.
Okay.
So I spent about 15 years in banking, and then another 15 years in mortgage banking.
Okay. Do you often get an appraisal waiver when you actually are processing your loans? How does that work?
We had a lot of experience with appraisal waivers over the last couple of years because there was so many refinances, people refinancing from 5 to 3. And so in that environment, we saw a lot of appraisal waivers, and part of it, the reason why, is because there was so much equity in in the property. And appraisal waivers, it's all algorithms. And so we know, or I should say Fannie Mae, Freddie Mac, the underwriting systems that we use, they have information often on those particular properties that they feel that they know what that property is worth. So if there's 20 to 35% equity in the property, it's recently that particular property has been appraised. There's an appraisal that's in the cloud somewhere. It's not unreasonable that we can get an appraisal waiver. It's often we don't have 20 30% down, so to say there's more than 20% chance would be a stretch at best.
Okay, that's no problem. And do you do manual underwrites in case they lose their approval?
We just like most mortgage bankers, we are able to do manual underwrites on FHA or VA. If it's conventional, generally we need to have a plan B, but most good loan officers, when they do a loan application and they know it's tight, they have a plan B in place. So if you saw something that happened and all of a sudden now, you're a week in and your lender is saying, oh my gosh, we lost our approval with conventional, we need to switch it to FHA. It might just be a matter that the new credit scores came in and now they were below conventional. limits and we had to convert it. So it doesn't happen very often because we try to have a fresh approval when you're out making, keeping in touch with our clients to keep their approvals fresh. But that's an excellent question to ask when you're vetting your lender is, when's the last time you did a credit refresh or check in with your client as far as do they still have their job?
And you do underwrite, you said earlier, you do underwrite in-house, there's underwriters in-house.
Well, and then I do say that 90% of all our deals are in-house with our own underwriters approving. We have automated underwriting. The first thing that we do is send it to an underwriter before even sending it to processing. So that's our system. And the reason I have the caveat in there is because we also, probably 10% of our deals, we actually broker out. Like if it's a niche,
right,
and it doesn't meet certain guidelines, then we have to act in a broker capacity. And that's when we are the middleman at that point. But it's very, it's less than 10% of our business or overall business.
So we kind of talked about the system, what a typical loan goes through your system. Do you routinely, I think Movement Mortgage, they can routinely do closing disclosures without loan being cleared to close. Is that correct?
Absolutely. It's part of our automated system that 10 days prior to closing, we start getting ready for that closing disclosure to go out because we don't want any delays there. And so a good loan officer will text their client and say, hey, we're sending out a closing disclosure, but it's not a final closing disclosure. We just need to get this closing disclosure out there to keep the ball rolling so we can close on time.
Okay. And do you do a same day sign and fund?
We can, generally speaking, we do table funding. We just kind of need to know that that's going to happen so we can get our wire ready the night before to go out.
And that's different.
Early enough wire.
That's different from the banks, right, Deanne? I think that's a big deal. The closing disclosures and the same day sign and fund.
Yeah, this is all we do. Like most of even the other mortgage bankers that you work with, we are about closing on time, getting things, no surprises, trying not to do extensions. So we're on the phone, just like you feel that you're managing every step of the way. We feel like we are the managers of this transaction. The escrow company, if you work with a good one, they feel they are the manager, and a good loan officer and realtor and closer. That's how they feel in the transaction.
Okay. So how do you update me? I'm the real estate broker. I definitely have no intention of getting my mortgage license whatsoever. How do you keep me updated through the loan process if I was to send you a client, Deanne?
Well, we have milestone updates.
Okay.
So when we send it to the underwriter, once we have a purchase and sale, we notify you. When the underwriter has given us a conditional approval, once we have a real deal going, that's normally within 24 hours. Next day, we'll have another email to you saying that you're conditionally approved. Once the appraisal, I order the appraisal, I send you a text, I've ordered the appraisal. Once the appraisal is reviewed and come back, we will send you another email notice.
Okay.
And then when we are ready to go to closing. So there's 4 times during the process that we actually notify you, and it's automated. And then we try to, because we want you to love us, if there's anything that's, happens quicker or there's a little delay, we will let you know on a weekly basis. We do a pipeline report, and we try to keep you, informed during that process.
Okay. So if I was to give you a client, which I'm contemplating doing, right, it's kind of building that relationship with you, Deanne, how do I, when there's something doesn't go right, and I know I've given you some very complicated situations in the past, when there's reservations or maybe the borrower cannot get pre-approved, how do you handle that? If you have reservations, for example, about the borrower.
Well, I don't write a pre-approval letter if I have reservations. So what I do is I'll communicate with the client, and let them know the things that they need to do in order to achieve, to be able to be pre-approved. And I would say probably that's why, when a good loan officer's letter is presented and people know who they are, there's a lot of importance to that, because they know it's just not a random internet approval that says, hey, I can do it. But I also, I asked the client if I could talk to their realtor, because the realtor is also trying to get them into a home. So I want to be able to give at least, not every last little detail, because I'm a fiduciary. I can't give too much information, but I can give enough to, after permission from the client, so you're aware of the stepping stones, the hurdles that we might have to get through before they're really genuinely pre-approved.
Wonderful. So that's kind of, in essence, you want to kind of get a feel for how does that loan officer communicate with you, communicate with your client, the process in general, because not only are you vetting Deanne, but you also are vetting her company. Make sure it's a good fit with your client base. And what I like about Movement Mortgage, if I could speak frankly, is Movement actually gets things done. There's been, I maybe only think of one, and I think it was the borrower that was the delay, that Sam or Deanne actually didn't close on time. That's, for me, is one of the hot buttons that will make me go ballistic when I've done all that I can as a real estate broker to go through the hoops, do the inspection, get the appraisal, meet for the walkthrough, and then to have a lender not close on time. I don't know about you, but I want to make sure I get paid and I want to set the right expectation. So some of the key things you might want to do if you're thinking about, let's see, what lender do I want to give this lead to? You certainly want to vet that lender, but then if you're on the listing side, I had another person email me as one of our top producers. She says, I just got a list, or I got an offer on one of my listings. I've never heard of this company before or this loan officer before. Can I vet them or can I look them up? And the answer is yes. This is the website you would go to. It's not, I kind of like always get messed up because NWMLS, it's NMLS, Consumer Access. You can go online to this website and you can pop in Sam Sentioli, you can pop in Deanne Yellen. We can look up everything about you guys. We can confirm that you did work in the companies that you worked for, Deanne. I just don't think consumers or real estate brokers specifically have vetted their vendor or their lender by looking this up. And that's accessible. This was something that was created after the 2008 crisis because of the scammers that were out there, the lenders that were doing kind of some crazy loans. So the federal government got involved. And this is a consumer access portal that allows you to look up by license number, by city, by state, by name. I have found some fraudsters over the years, even since 2008. So if you have kind of this weird feeling about maybe a pre-approval letter, or you never work with this person, or you want to check on your lender, maybe you've worked with this guy for years and just want to kind of just double check. Doesn't matter what city or what state, if you're in Idaho or if you're in Washington, this site is very helpful, and it definitely shows maybe some lies or some deceit that are out there, and you can kind of be the hero to go back to your client and say, gosh, this website, you can go in there and it looks like, it was an online lender who has not been doing any Washington loans in over a year. You actually can look that information up. So take advantage of that. If you're kind of wondering if your lender is on the site, has a good track record, or has the experience that they claim, that would be a good website to check out. And Shannon, if you could put that in the chat, that would be great at some point. This example, though, I was telling you, I was talking with this other agent from Compass, and she was talking about her borrowers. I always use borrower. I have to kind of stop myself because we always say client, right? But they're borrowers, right? That's in the mortgage world, that's what they're called. And so they start the process sometimes, and often, I don't know if you can speak to this, Deanne or Sam, but they start online most of the time, right? Kind of shopping, and they look at oh, what is this house? This is a beautiful home. And they go onto the mortgage calculator, and oftentimes they get ahead of themselves. This is what I find. And they find out that the house is, they found it on an online website, and it says that the mortgage payment would be a calculator of this. And they get all excited when the reality is they haven't had their credit checked. They haven't figured out what the insurance, they haven't figured out how much down payment. They haven't had a full strategy session with a loan officer, they're just thinking, they're just kind of ballparking it, but their ballpark could be way off. So when I get a pre-qualification like this from a borrower that says financing pre-qualification, minimum of 20% down, credit score 800, you start to ask yourself, is this a valid pre-qual? It didn't even have letterhead on there. It was just a blank piece of paper. So now Kathy Carlson, I'm just not picking, I mean, I just made that number up, but did she really properly go through the pre-approval process like Deanne had said, or maybe she didn't, I don't know. Another one here, the Money Store, the pre-approval letter. I've never heard of the Money Store. I don't know if they're a trusted brand for over 40 years. I may want to go ahead and vet that, or want to check that out. But this is an interesting pre-approval letter here for these types of clients. 30-year, a lot of times they'll put the loan amount, the loan term, the property address. Maybe you guys can speak to this and we can flip back on the screen, Dan or Sam. But the third one is Sam did for me a few years ago. And that was issued in August 24th, 2020. Proposed loan terms are this. You guys, Deanne, Sam, you want to chime in? I don't know. I mean, what am I looking at here?
Well, yeah, that's a kind of a snip of it. It's changed a little bit, but yeah, they're real quick. I'm shocked with all the regulations that there's not a legal requirement for what a lender can put out for a pre-approval letter. There's not. We've gotten 2 or 3 transactions this year where the borrower had a pre-approval letter from a big bank, and the big bank, they never spoke to anybody. They never even pulled credit. They're just issuing them. And there was problems that we were able to kind of fix and correct. So there's a pre-qual, which is just a discussion that the loan officer has on the phone, maybe 5 minutes, maybe an hour, to kind of make sure everything kind of fits in the general boxes. And that you can issue a pre-qual letter at that point. It's better than nothing, but it's not super strong.
It doesn't require a credit check, right? On a pre-qual?
Well, they should be, they may or may not include a credit check. So that's something you want to follow up on. But their movement has a version called the loan officer pre-approval, which is kind of like the pre-qual. And then there's an underwriter approval. So if it doesn't say underwritten approval, there's the automated approval, which is pretty good because you've entered everything, you pulled credit, Fannie Mae says that it's approved if everything that's input is accurate, but that has not been vetted by an underwriter yet. So an automated underwriting approval is pretty good. That's kind of the standard. The next level is a fully underwritten, where an underwriter looks at it and yes, and then so you're ahead of the game, and a lot of variables are taken out. So like
it would be 3 different levels. It sounds like
letters.
So it sounds like there's no rules around it, but they have to be issued on, they have to have the loan officer's name, your license number, all of that has to be on the pre-approval or even the pre-qual, correct?
Yes, the loan officer's contact information, license number has to be on there. Outside of that, it can say anything. It really can. I mean, it's up to the company to police what their loan officers are putting out, and most places either don't care or they're too busy. So that if you're getting something and it doesn't say fully underwritten, or if it's not, or if an automated approval is good enough, that's great. But especially if it's coming from, I'm not naming any names, but some of those bigger banks, and it's never hurts to make a follow-up phone call and say, have you pulled credit? Has this been run for automated approval? Has an underwriter looked at it? Because those are 3 very different levels. And Movement will do, fully underwritten loans. We don't do it on everything without asking. It either has to be variable income or we have to get an exception. But we do fully underwritten pre-approvals, and it says that on the letter, and it definitely helps.
Yeah, I would say that you probably don't want to be waiving your financing contingency unless you have an underwritten approval from your loan officer. So I think it's great that we've kind of established that there are 3 different types of pre-approval letters out there. But again, if you don't know, ask more questions. If you're a listing agent and I saw something like this, it's a pre-approval, it's pretty clear that Sam, it's not an underwritten approval. This would just be a pre-approval, but it doesn't hurt to call Sam if you're the listing agent and say, Sam, I'm reviewing 3 or 4 different offers. Did this client or this borrower, did you actually check the credit? I mean, Sam, you're obligated to say that, right? Did you check the credit?
Yes, I mean, they should be, yes. But yeah, we've had people that the borrower called us out of the blue and said, hey, I've got this pre-approval letter from this lender and I never gave them my social security number. So that they never pulled credit. So it's Wild West. That's the one weird loose end that's not overregulated in mortgage.
Okay.
So, Rochelle, can I just comment on it?
Sure.
So if you were to call me and say, hey, Deanne, why didn't the underwriter look at this letter? It just says it's a loan officer pre-approval. I might say to you, they both have been at their jobs for 8 years. Their credit scores are like 100 points higher than they needed to be. And I've already verified the down payment and they've never had a blemish in their life.
Okay.
And our underwriting department doesn't want to get stuffed up with that approval, that process.
Okay, that makes sense. See, again, when you have experience, that makes sense, right? So when I can understand what underwritten approval means and the process that goes into underwriting a file, and then the borrower's behaviors or their backstory, right? Then it makes a lot of sense, and then it gives me more confidence as a listing agent going, okay, this particular client should win over, say, the other one who hasn't even submitted an application. I mean, I got a letter that makes it appear like that they have, but it hasn't even been through the credit check process. I'm seeing, if you get multiple offers, I'm seeing a wide array of different online, literally an online pre-approval that I've seen. I mean, I was like, I wonder if this person even talked to somebody about whether they could get pre-approved for a loan or not. So it makes you really, really concerned as a listing agent when you're taking the home off the market and going with picking one over another, if you have not had kind of a conversation with that loan officer or that situation. And if you guys have questions in the chat, go ahead and chat away. Let's go to the next slide, Shannon.
Go for it.
So this little sheet right here is what we call a loan estimate. It's a sample one that we had. Has this changed, Sam, or has this been the same kind of?
No, I mean, there's different formats, but that's
pretty close.
Yeah.
So this is the loan estimate. Every borrower, when they start working with, say, a Dan or a Sam or whatever they work with, you guys are required to provide a loan estimate. Is that correct? That's
this
what they
is
call it.
This is not actually a loan estimate. This is a cost illustration.
Okay.
A loan estimate is more of the legal term, and that's when we actually have a property and when it becomes a real deal.
Okay.
But the ultimate goal is this loan illustration is when we are in the pre-approval process and trying to educate our client on what the cost would be. If you purchase for a 1.150, put 20% down. This is what it might look like on this given day. It's a snapshot. When we actually do a loan estimate, we are bound by the fees that we put on that estimate because it's a real deal. So we actually have to get quotes from title companies, escrow companies, appraisers. And if anything that we put down is not accurate, and we have to make a change, we have to do a new loan estimate. We have to redisclose.
Okay.
So this is an illustration for education purposes.
Okay. But you will get, if you did find the property and you got mutually accepted or your contract was ratified or whatever the terminology we used, you won the deal.
You won the deal. Yeah, we send it right away within 3 days.
Loan estimate. So within 3 days, is that what you said, Dean?
Yes.
Okay.
Yes.
That was good to know. Because this is what's important to know is that you have a loan estimate, your consumer or your borrower or your client gets a copy of that. Then you have, in this case, it's a Washington state contract here, a 22A financing contingency. You've got number 1A that talks about, this is a 3.5% down purchaser, and it says, if required for the subject property within 5 days on line 11. Do you see that? Shannon, maybe you can highlight that. For the purposes, yeah, there you go. She's probably got her cursor right there, 5 days. So Deanne says that she can get that estimate within 3 days. So
we are as soon as we have the contract, we're bound. to have it out within 3 days.
In the Washington State contract, default is 5 days, but I have used that. And I don't think a lot of you know your forms well enough to know that that's a strong point. If you sent me an offer on one of my listings and you had maybe cut that timeline down to 2 or to 3, that shows that you have already made that application and that you're actively working with that loan officer, and that loan officer can produce that closing estimate. So to have that conversation, Deanne, if I was in a multiple offer situation, can you produce an estimate for my client that's 20% down? Can you get that to me in the next day? Is that going to be too much of a push for you? Because you've already.
So if you're in contract or if you're in negotiations or
Well,
you're income.
I mean, it looks like I'm going to win this one on Main Street.
Oh yeah, I'm gonna app it, which means I'm gonna put the address in the computer. I'm gonna run it. I'm gonna send it to underwriting.
Perfect.
And even if it wasn't quite ready because they had some missing documents, I could still disclose within 24 hours of you asking me to.
Okay, so I use that 5-day period, and I call this the shopping clause with my client. So if you see, that gives them the right to terminate or make switches, because they have to basically supply with their offer. They should, again, it's not law, but they have to confirm and lock all of that within that 5-day period, within that 1-day period, whatever they write on line 11. That is the shopping clause that allows them to decide, okay, I want to work with Deanne, but then maybe I found a better deal with Sam, but they all both work at the same company. So it's a bad example, but you get what I'm saying. You have the ability to work with your client to, maybe they've got a loan, they've apped with, say, an online mortgage person, and you're just not feeling solid about it, and you're representing them on a purchase. It doesn't hurt to get a second opinion in that 5-day window and say, Deanne, I'm not feeling solid about this online lender. Can you please run this through the system? And it does not hurt. It does not usually cost the client anything more except their time and their conversation to app, but they can always switch lenders within that 5-day window without having to redisclose to the seller that they are switching lenders or loan types. So that would be a very strong position if you're a buyer's agent, to go in with strength. And Shannon, if you were a buyer and you said, Shannon, Shannon's like, I'm working with the lender. Let's role play that real quick, Shannon. So I'm excited. We're going to write this deal up. I'm going to write 5 days. Who are you getting your loan through?
I work with my local bank, Bank of America. So.
Okay. I understand how important it is to work with your local bank. I think that's a very strong position. Have you considered working with a preferred lender who can streamline the process and kind of go through and perhaps even save you money? Have you thought about maybe looking at another option as another, path, comparing?
Sure. I mean, yeah, if it saves me money, absolutely.
Okay. So what it would take is I would put you in touch with my preferred lender, Deanne or Sam. I'm going to have Deanne or Sam call you, because I'm going to write this deal and provide for a 5-day shopping clause to allow you to kind of, in essence, basically shop what you're getting at your Bank of America and see if we can find a local lender who understands the process, who I work very closely with and has worked with me for many, many years. They're very experienced in what they do, and they work for a company that I completely trust, that has proven themselves time and time again to ensure that the deals get done in the time that we've allocated in this transaction. They often can save you on rate, but more importantly, they will educate you on the process and act as a consultant to make sure that you're not getting taken for a ride down the Bank of America rabbit hole, when in essence, they can maybe assist you with the loan process. We will have to lock the rate. We will have to decide in a very short amount of time. But is it okay if I have Deanne or Sam call you in the next 5 minutes, Shannon?
Sure.
That's how you do it. You don't want to get in the habit of just saying, let me have Deanne and Sam call you, or you can call Deanne and Sam in the next 24 hours. The problem is that the consumer, the borrower, they won't do it. They're too nervous. They're too shy. It works better if you have the lender call them to be in that position. And oftentimes what we see is that they're super impressed by a loan officer that is vetted properly by the company, that has been proven themselves to get things done, and that offers competitive rates and competitive pricing. And they're often, if Deanne and Sam are going to call that person, you'll say, hey, I'm close to getting this pre-approved buyer in contract. They've already made application with their bank at Bank of America. So then it gives Deanne and Sam the heads up that they're probably going into a competitive situation and they're going to need to address those objections, I guess, of working with the bank and show their value. If they find that the bank is, Sam's done this before for me, he's like, gosh, the bank actually, because the guy has been there banking for X amount of years, or because they have the special program, it's better for him to stay there. He'll tell me straight up. But if he can save him money and there's definitely a relationship that's been built there with that client, all day long, Sam and Deanne are fantastic at making sure that the client is super, super happy. So you have that window of time. If let's say I've already submitted the offer with Bank of America, Shannon's pre-approval with the offer, but within 5 days, we end up switching gears. All I have to do is just update the listing agent that, hey, we're going to actually go with Movement Mortgage instead of Bank of America. And most of the time when I do that, the listing agent that I talk to, and within that 5-day window, are like, oh my gosh, thank goodness you're using a preferred lender. They're super excited because they find value in that as well. They know that they our preferred lender often can get things done where oftentimes the banks or some other online or some other type of unproven or unvetted lender cannot. And we're at the 9th hour and we're trying to get something through, and then we can't even, we're calling like layer after layer. And I don't know about you, if you've been experienced or you've been in the business longer than 5 to 10 years, you've probably been there and done that, and you're probably over that. So I kind of explained what 1A is all about. The 2A and 2B is like near and dear to my heart. So I told Shannon, I said, I don't care if I'm going over 608, and if I even go into 615 tonight, I'm definitely going to cover 2A and 2B, because I see too many of you just going with the defaults, and that's part of vetting the lender. You want to hold the lender accountable, and the way you do that from a listing standpoint and from a buyer standpoint is really negotiating with strength. If you know that your borrower, your buyer, your client is making application with a preferred lender, there is nothing wrong with going in with 2B, making it easier for the listing agent and the seller, and also, in my opinion, easier for the buyer to plan things out, because you know that once that 15 days passes, there's no way for that buyer to obtain their earnest money with the financing contingency. Most states operate that way. Idaho, Colorado, Utah, all of those states operate with a deadline. Once the financing contingency expires on whatever date is set forth in the contract, the earnest money becomes non-refundable at that point, and it goes to the seller if there's a breach with that financing. With Washington, we still have this opt-in, opt-out kind of situation here in 22A, and most of you just let the default go, and then you call me in a panic when things are going sideways with the lenders or with the lending situation. And here's how the system goes. You usually call me for the listing agent and go, the buyer's lender didn't perform. It's the last day, it's a day before closing, and we found out that they're not able to get the loan, and something happened with this or that, and the lender didn't calculate this correctly, and I don't know what happened. It's just off the rails. That's kind of how the story goes. And I go, let's look at your contract. We pull up the contract and we look from a listing standpoint where we represent the seller, and we see that 22A, term 2A, that we're on day 28. We're like only 2 days away from closing. And I say to them, did you as a listing agent send over the notice to have them remove their contingency? And the listing agent looks at me or on the phone, and there's a big pause, and like, Rochelle, I didn't do that because I didn't really want to kind of make the parties anxious. Or there was a sense of like, things were going along fine. I didn't think that I have to actually, and sometimes they don't even read the contract where they actually know that they have to do something in order to properly waive. And then hopefully you don't have a bot or a seller that's like this, but I have talked to them where the seller then calls me after I speak with the listing agent and say, what can you do to get me my earnest money? This seller or this buyer has been ridiculous to work with from start to finish. They've asked for this and that on the inspection, and the deal's unglued, and I've already packed my boxes, and I've already got the moving trucks, and I'm scheduled to move out of my house this weekend. Is there anything you can do to get the earnest money returned to them? And it puts me in a very, very awkward situation, because I have to kind of represent you as one of the Best Choice Realty agent, but yet also represent them. And I have to kind of draw their attention to the contract and say, I'm sorry, there's nothing I can do. If they are sending over a notice of failure or termination because they're financing contingency, they will get that earnest money back. Unfortunately, there's nothing I can do to retrieve that. When in fact, if you actually read the contract, if you would have negotiated, Mr. or Mrs. Seller, to have that automatic waiver, once that day 15 in this case passes and day 21 is the default, then that earnest money is non-refundable. And whatever the lender does, whatever the failure is, once that timeline has passed, that earnest money would become theirs. There's not this debate or this contingency that lasts the life of the escrow. So hopefully that is clear. If you have any other questions about that, or if you want to discuss a particular situation that you've encountered, we certainly can have a discussion about the A and the B and the differences and the plays that you want to do. But it really needs to be a discussion that you have with not only your seller when you're discussing the offers that you have that come in. Maybe you do want a counter offer. Maybe it's a full price offer. Maybe it's above asking, but they've kept the 2B. That is not in the benefit of the seller. I'm sorry, the 2A. It's not in the benefit of the seller. 2B is the benefit of the seller. 2A is the benefit of the buyer. But oftentimes you guys don't understand the differences between the 2A and the 2B. And it takes, unfortunately, a bad experience to draw your attention to that. And honestly, it's a lot easier to negotiate when you're dealing with a deadline. And if Deanne and Sam know that they have to get things underwritten, cleared, ready to go to escrow within 21 days or 15 days, they will work with that deadline if they know that that's what you're working with. Or another lender, if you're not working with Deanne and Sam, you will need to draw their attention to let them know that, hey, after day 15 on this file, your earnest money is non-refundable. My borrower will lose $50,000. You need to purposely advise them, because unlike us, we have clients, lenders, they're considered borrowers. There's not the same kind of agency duties that are required between a loan officer and the borrower as there is between the agent and the client. It's a different set of duties. And we do have a duty to make sure and inform our clients the difference between what contract term versus another contract term, and make sure all of the third parties follow the contract as outlined. So there is an automatic waiver. I would encourage you to start to use that if you are a seller or a listing agent. With everything going on where borrowers are changing lenders or loan types or changing lenders or what have you, it probably would be a strong point if you get multiple offers, certainly, to counter and make sure you change the contingency so it is 2B if you have the edge.
I'll pipe in too, Rochelle. So in terms of the way that I like to operate, at least the way that I, as a listing agent, will operate, my philosophy is 2A is old fashioned. So the way that most of the deals are being done now, it should be a 2B. Unless there's, for some reason, they send it over, you're really not wanting to rock the boat, but most of the deals, it's modern, do the 2B, leave it at the 21 days. The way that you can tell your buyers about it is say, you've got 21 days to get the loan. If you can't get the loan after that, then your earnest money is at risk. And that's what you can tell them. But in terms of the shopping clause, yeah, Rochelle put nail on the head there. It's your shopping clause. So shop around within that window, but afterwards you're locked in. You're locked and loaded.
And you can certainly get permission, and you can switch lenders, but that requires a form and you have a process for that.
So just save yourself some time. And I think too, with as a listing agent, for me, if I receive an offer, and even this is if you have multiple offers too, which we're seeing right now in our marketplace, and the offer is perfect, there's nothing you would change, but they have selected 2A, I would use a form 36, counter them on that term, and I would call the agent later and said, hey, looks like we're good to go. Your offer is accepted. There's a couple little tidy items I need you to address and have your buyer initial, but other than that, we're ready to go. And the number of times I can say with certainty, I don't think I've ever had anyone back out based off of me just changing it from a 2A to a 2B. So do your seller a service and use the form 36, leverage it in that way, and get them to do the 2B. It will pay off, and it's less paperwork for you down the road anyway.
And I'm going to just from a buyer's perspective or borrower's perspective, because that's where I come from. you got it with, if you're putting in an offer, and you really do have to talk to your lender, find out what the turn time is for appraisals. Find that out. Find out if it's an in-house product or if it's a brokered out product. Because keep in mind, if it's brokered, we lose control.
Yeah,
There's a little control that's lost. So you need to, as a buyer's agent, you got to protect your buyer and, not wave things too soon before you know what the reality is. Because hiccups happen and you need sometimes you need time to respond.
Yeah, it surprises me how many new agents don't make that phone call and actually have that conversation before they write. And they need to know that, because if you're going to include the lender in your negotiation, you've got to know that you can meet those deadlines, because you do have an obligation to your client in that way. So I'll just open it up. If there's any questions or comments, I'd love to hear from you guys, but that was a wrap. Thank you, Deanne and Sam, for your informative information tonight. Hopefully that.
Sorry, one last question. Can Deanne, can you repeat what she just said about you have to know whether or not it's from where the loan is coming from?
So Maricon, when
Yes.
you have a borrower or client and they're making an offer and you're using any mortgage banker, is to find out, is this an in-house product or appraisals on, if it's some property that's there's not a lot of appraisers, let's say, and you have 15 days, but really it might take 21 days. You don't really want to waive your financing in those situations. Now, if it's a house in King County and it's in West Seattle, and we're going to get that appraisal back in 7 days, so there's not a problem. But let's just say it's in Eastern Washington and there's fewer appraisals and it's taking them longer to get that back to us. So it's not one goes for all. You have to know that what your buyer is able to do with that lender and their situation. So it's just saying, hey, Deanne, what do you think about it? 15 days, is this gonna, with this particular property, this particular borrower, this particular loan, can you pretty much give me a 99%? It's gonna be fine. And I'm gonna say, absolutely, go for it.
Yep.
Thank you.
You're welcome.
Thank you.
Definitely ask down payment. How much down payment? Have you verified the down payment? Have you checked the credit? And what's your term times for appraisals? And I'm going to write a pretty strong or a very, very tight closing date. How quickly can we get that done? Those are kind of the terms that you want to talk with your lender about. So down payment, seasoning, making sure that that down payment is official. We've had a few. And then also making sure the turn times work. Those are kind of the key things.
Mm-hmm.
Shannon, anything else?
Yeah, a couple questions. So I'll rapid fire them. So how many listing agents actually call the lender when they have offers on their properties?
You want to know what Best Choice Realty does? We do a lot better than the average.
I know. What would you say is the average in the industry though? How many listing agents actually call the lenders? And that might be for Sam and Deanne. How many people actually call you?
Well, we want the business, so we're calling the listing agent. We call and say, hey, we've got this great client and we're ready to close on it. They're the best. And, so we're the cheerleaders for your clients. So we're calling them before they call us, believe me.
I've done a poll in some classes with other brokerages, and I would say that it's 1 out of 4. It's not as much as you think, but still that would be a nice edge if you could. And I know we promote that, making sure you call the lenders in our contract negotiation class. If you're trying to decide between one offer over another, it's a strong play to go ahead and reach out to that lender to connect with them. So Shannon, I hope that answered your question.
Yeah, no, and I think it's also, and also thinking about people don't know this number, Rochelle, so I'm hoping you can share it, is what is the likelihood of a finance deal actually falling apart? I mean, what are the odds? So why should we double app? Why should we do all of that? And that comes down to the risk percentage. It actually is probably higher than what most people think, right?
Oh yeah, no, I've tracked this number for close to 20 years now. So I know that number, and it's 1 out of 4 is at risk.
Yeah.
So that's why you kind of lean on cash, right? So, or you really vet that lender to make sure that lender is going to perform. It's gonna be a smooth process. So.
Yeah, I don't want to give a number what it is, but let's just put it this way. In my career, I couldn't say there was a handful of them.
Okay.
You know, we closed the loans.
Mhm.
Yeah.
It's on,
Outside of appraisal issues or sellers can't provide clear title.
No, I mean, I had the nightmare because I remember it, and it was a week before closing, and $150,000 tax lien shows up on title.
Right.
And they had $75,000 earnest money on the line.
Right.
And it was going to go away, but who could prevent that? But guess what? We closed it.
right,
It was my last loan with Eagle Mortgage. They did it. So
years ago. So again, it's few and far between, but that's why you're dealing with experienced, preferred lenders that have done it a long time. I think the failure actually comes because of the lack of communication, or we're writing crappy offers that haven't been properly communicated between the realtor, the lender, and the client. I think that's where a lot of that failure happens.
And
But
sometimes Rochelle, is the buyers have cold feet and they're actually call us and say, get us out of this.
Yeah.
And we don't do that. If you want to stay in business, you don't do that.
But there are people that do it in this business. I
yeah.
know. All right. Great question, Shannon. You're gonna really spark dialogue here. Keep
That's
going
okay.
with that question.
Yeah.
What else? Is that it?
Nope, that's all.
Okay, it's a wrap. Have
Thanks,
a great week,
everyone.
guys. We'll
You
talk
too,
to you
guys.
next Monday.